Well, after the Fed cut rates by half of a percentage point in mid-September, stocks have climbed higher. The S&P 500 is within striking distance of an all-time high, and in fact, it ended last week with its fourth straight week of gains. So with that, I want to bring in my first guest. He's going to walk us through the markets and whether or not this momentum can be sustained, what it means for IPOs too. Joining me now is Joe Zhao, managing partner at Millennial Capital. Joe, thank you so much for joining.
Thanks, good to see you.
Yeah, it's great to see you as well. And you're a perfect guest, especially today, because we're going to talk technology eventually with Oracle celebrating the open. But on top of that, you actually were a part of the monetary policy team under the Fed in DC for a period of time. After this much better than expected jobs report on Friday, how does that impact the Fed's decision going forward?
Yeah, I think the short and sweet answer is it just increased the odds that they'll probably do 25 bips next meeting because the interest rate doesn't need to go down that quickly. But to take a step back, the Fed doesn't like to make a decision on one data point. It's very prudent. It likes to make a decision over a period of data points because it like to be sure that it is onto something. So usually one data point doesn't swing the directions of policies either way. If this were to happen, if this data point were to take place over several data points, then I think you can make an argument that the direction of rates would differ. But this one data point doesn't really change the direction very much. But all things equal, what this data point also shows is the economy, the labor markets are more robust than people thought. Mm-hmm. That we're more likely to going to go into a soft landing, and that the neutral interest rate, the one that keeps the Fed sort of in balance, is likely higher than 2%. So which means the Fed will need to cut from 5% to lower, but it doesn't need to adjust the rates that aggressively. So I think it just means, I don't think it means much, just one data point. But if it means anything, it means that they're more likely to cut it by 25 bips next meeting.
It's interesting what this will mean for risk assets, right? The fact that interest rates are coming down, investors we know are always searching for yield, what it might mean for IPOs, but also money coming off the sidelines. With lower interest rates, how could investors and Americans see that funnel through into the markets?
Yeah, so the technical term is called the monetary policy transmission mechanism. That's a mouthful. What that really means is as the central bank changes rates, it flows through the financial market, the banks, the asset management firms, and flows to the real economy, and that is a 6 to 12 month process. And so in 2021, the reverse happened, right? They raised rates, and then capital flow to riskless assets like cash and treasury bonds, and now it's the reverse. So in the next 6 to 12 months, you're seeing more allocators like LPs and pension funds and family offices and endowments to rebudget their asset allocation probably next year in January, where they're planning, let's say in 2025, they're going to put more of their pie into risky assets. So these things don't change overnight. It takes 6 to 12 months. But all things equal, what this means is you're going to see more capital coming from the allocators back to the general partners at the PE hedge funds, VC funds. And so more capital is going to be allocated towards the risky assets. And then once the VC, the PE funds, the hedge funds, the tech funds receive more money, then it takes 6 to 12 months for them to deploy the money. So you're not going to see that immediate effect now, but it does take it is a 6 to 12 months process.
And we are definitely getting started on that process in the wake of this decision, Joe. I want to talk about earnings, of course. The third quarter reporting season set to kick off at the end of the week. JP Morgan starting, and Delta Airlines, as is usually the case here. What are your expectations for third quarter earnings growth, knowing that GDP was up an impressive 3% last quarter?
Yeah, so not too different from the average street expectation. And the reason is the way to think about earnings growth rates and the GDP is the macro economy, and earnings are the growth rates of the biggest companies, of the 500 companies or 1,000 companies. Usually the companies outperform the real economy because the management at these companies are doing such a great job. They're some of the best people in business. But secondly, because they're always improving their margin profile, they're cutting costs, they're increasing revenue. So if all things equal, the GDP is growing a little bit faster than expected, you would expect earnings growth rates to also be pretty good. Now, we are at a part of the cycle where higher interest rates from the last 2 years is going to slow down the economy. So earnings growth rates will be slower than last year or 2 quarters ago, but they'll still be positive. If GDP is at 2 to 3%, I would expect earnings growth rates to be somewhere in the 45%. The actual margins is hard to argue, but with that backdrop, it's providing a really good background for equities.
So a pretty good background for equities. And Joe, everything that you've been saying, all the data points, all the Fed speak that we've been hearing, of course, points to that as well. But I do want to talk about the potential for an October surprise, right?
Yeah.
October can be a volatile month.
Right.
Certainly, we see that there are high tensions in the Middle East.
Yeah.
And so I'm curious what investors might to expect on that front.
Yeah, so I mean, when I think about October surprise, there's really two components. There's the political surprises, which I don't think anyone could really predict, and there's the financial market surprises. And so I, as an investor, I don't really expect any surprise unless there's a surprise. But having said that, having watched the markets over several presidential cycles now, the markets tend to be muted in either direction in the month leading up to the elections. And that's because the bigger allocators are just sitting on the sidelines watching kind of the results of the election and sort of which direction the country goes for the next 4 years. So I don't expect to see the markets acting too wildly on either direction for the next 4 weeks. But then all things equal, if let's say the elections pan out to be the way expected, you usually see the markets kind of rallying in November. That's because then you remove one piece of uncertainty, you sort of know which way that the country is going, and then the markets will kind of tend to rally a little bit more in November.
Is your firm, Millennial Capital, predicting a certain outcome in DC?
That's not what I do. I mean, I hope for what's best for the country and what's best for our people, but I think that the one thing that I'm really looking forward to is just, I think beyond the elections is sort of how what we focus on. The AI, the tech investments are really just adding a lot of fuel to the economy.
And we're going to talk much more about those technology, AI investments, as well as what we might expect from the general IPO market. Joe, after that opening bell, you're going to join me from the floor of the Stock Exchange. Oracle again set to ring the opening bell, and the Stock Exchange welcoming Oracle here ahead of the NYSE Tech Summit that kicks off this evening. So we'll have plenty to talk about throughout this show.